This episode is brought to you by Nespresso and Samra Origins by the Weekend Coffee Collection.
Introducing Samra Origins. My collaboration with Nespresso is a connection to my roots, to my mother, Samra. Coffee that hits the right notes. It transports you. Crafted with unique notes and bold, soaring flavors. Experience a taste that moves you. Nespresso and Samra Origins.
Discover more at Nespresso.com.
Il prossimo 9 luglio sarò al Directa Summit 2025 a partire dalle 16 a Palazzo Mezzanotte, sede di Borsa Italiana, per un grande evento dedicato alla finanza, in cui parleremo di come costruire un portafoglio in ETF partendo da zero, di piani di accumulo e di tanto altro ancora, insieme a molti amici, tra cui Paolo Coletti e Mr. Rip. L'evento è gratuito e l'accesso è libero fino ad esaurimento dei posti. Iscrivetevi sul sito di Directa e ci vediamo a Palazzo Mezzanotte. Welcome back to The Bull, your personal finance podcast. There is one fundamental question every investor must ask, more important than any other. What portion of my savings should I invest in risky assets? Deciding how much of your capital should be exposed to market risk and how much should instead be allocated to so-called risk-free assets is the fundamental step in building your portfolio. Every other decision about instruments, factors, currencies, and so on will always be a consequence of that first crucial choice. And there's no one better in the world to help us answer this question than Victor Haghani. He grew up professionally in the legendary breeding ground of financial talent known as Salomon Brothers, and in 1994 became the youngest founding partner of what is still considered the most famous hedge fund of all time, Long-Term Capital Management, also known as the hedge fund of Nobel laureates, which included, among its partners, two Nobel Prize winners, Myron Scholes and Robert Merton, as well as multiple superstars from the Wall Street elite and brilliant minds from MIT and other top universities. The story of LTCM is well known. 4 years of record-breaking returns, followed by a sudden collapse triggered by a stunning chain of events, perhaps the clearest example of the old saying that markets can remain irrational longer than you can stay solvent. That's when Victor learned the hard way just how vital it is to determine the right level of risk in one's portfolio. Since then, his prolific research activity and career as a wealth manager led him to develop an investment model that can be an invaluable guide and inspiration for all of us. A model beautifully summarized in his much-discussed book, The Missing Billionaires, which you'll find linked in the episode description. Victor Haghani is not only a giant in the history of finance, but also a person of remarkable humility, generosity, and kindness, which makes me all the more grateful to thank him for accepting my invitation to The Bull. And without further ado, here's my conversation with Victor Haghani. Enjoy it! Dear Victor, welcome to my podcast, The Bull.
Thank you, Ricardo. Great to be here.
It's a pleasure to have you here. I wish this interview would last 2 to 3 hours, but I have to choose the topics wisely. To start with the most important thing, I loved your last book, to say the least, The Missing Billionaires. And you're going to tell us where the missing billionaires are later in the conversation. As I always tell people about this book, it's a kind of one-stop shop if one wants to really figure out most of what it takes for sound investing. So let's start with what motivated you to write it.
Sure. So, there are so many personal finance books out there. Really there's, thousands of them written by both practitioners and academics. But almost all of them focus on what you should invest in, and they don't discuss that much how much you should invest in those things. So there's kind of the what question, the selection question, what should I invest in? But then there's the how much question, and that how much question gets addressed, but not that deeply. And so we thought there was really a need for a book that focuses mostly on the how much question. And that's really the idea behind the book. We thought I think everybody who writes a book always thinks there's a vacuum or a gap there to put the book into. And that's what we thought was the gap that we were trying to fill. I think another, motivation for writing the book is that both my co-author and I, James and I, that both of us had worked in the finance industry. And in particular, we had both been proprietary traders at hedge funds. I worked at LTCM, and before that at Salomon Brothers, and James worked at Citadel, and before that worked at CRT and Nations Bank. And both of us had kind of wrestled with these questions of sizing. Both of us had been through periods where we got the sizing wrong, and the firms that we worked with got the sizing wrong. And we kind of felt like, geez, we thought about it a lot after those events, and we felt that maybe there was something that we could say to younger versions of ourselves that would be useful, and it's sort of like, well, is there something that we could have said to us when we were in our 20s that would have helped us to avoid the problems and the mistakes that we made when we were running large amounts of capital. So part of it was writing to our younger selves and people that were at the start of their journey on Wall Street and investing. And as I say, we really felt that there was a gap in the literature there to try to put something into.
When it comes to deciding the right size of your capital to be invested in risky assets like stocks, which is the most important topic you address in the book, you came up with a wonderful formula, which is the Merton share. It's pretty unbelievable to me that it is not so widespread. It is generally known among academia, it is known among some practitioners, but it's not the typical way, for example, consultants advise their clients about how to allocate their wealth in a portfolio. And I cannot understand why, because it's a great idea, and beside the technicalities and the mathematical derivation, it is very simple and very straightforward. But I'll let you introduce the concept because it's highly relevant for today's conversation.
Sure. Yeah, so we talk a lot about the Merton share in the book, and this is a very simple rule of thumb that was derived originally by Robert Merton when he was very young and just starting to.
He was 25.
I think something like that. He had come from math and physics. He had been out in California at Caltech, and he had all this mathematical abilities. And then he came to finance at MIT with a student of Paul Samuelson, one of the great economists, financial economists. And one of the first things that he worked on, or one of the first papers that he published, was using these mathematical techniques from, that are, equations that they were using for guiding projectiles and so on. So that's kind of this connection to rocket science, but using some of that math to solve the lifetime investing in portfolio choice problem. And with a very simple, stylized set of assumptions, you get this result that the amount of your savings that you want to put into the risky asset, in a world where there's one risky asset, say stocks, and one safe asset, say government bonds, that the amount that you want in the risky asset is a simple function of what's the extra return that you expect to get from this risky asset relative to the safe asset. So the higher that is, the more you want to invest in the risky asset. Logical. How risky is the risky asset? The riskier the risky asset is, the less you want to invest. And, the measurement of risk in this stylized world is not standard deviation, but variance, which is the standard deviation squared. So the higher the risk measured in that way, the less you want to invest proportionally, so linearly. And then, you need something to represent your personal degree of risk aversion. And the more risk averse you are for a given amount of return and risk, the less you want to have invested in that. And, so this formula, we summarize it as mu over gamma sigma squared, where gamma is the coefficient of risk aversion. I don't want to make anybody's eyes glaze over, but that very simple thing, it's a ratio of return to risk, and then kind of normalized for your personal degree of risk aversion. And, it's a very simple thing. You could say, like, one of the ways that we like to talk to people about is we say, okay, imagine you're in a world. So we don't need to necessarily go to we don't need to get into utility theory and the derivation of it and what does gamma mean exactly. Instead, we can just say, imagine that you're in a world where equities are offering an extra 4% above safe assets, an extra 4%. And imagine that the riskiness of the stock market is kind of normal. It's not super risky like it was in early 2020 with COVID or in the financial crisis in 08-09, but it's like a normal amount of riskiness. It's not super low risk like it was, say, in early 2017 where it hardly moved at all, but you're kind of somewhere in the middle. And now just say, how much equities would you like to have in that environment? And once you answer that question, you've now calibrated the whole thing. So let's say that I say, in that world, I would like to have 70% of my savings in equities, 4% normal riskiness. I want to have 70%. Okay, well, now you're kind of, now you have set the starting point, and you can just look at the market today and see what is the expected return of equities relative to bonds. Well, how do you come up with that? There's lots of ways to come up with that. I mean, for one thing, every large investment manager is publishing what they call their capital market assumptions, where you can just go and look, and we've done that. We've tabulated the capital market assumptions from 12 different investment managers from, from PIMCO to Goldman Sachs to Morgan Stanley. You could average those together. That gives you this expected return of the stock market. You could believe them or do it yourself. And we kind of know what to expect more or less from owning long-term bonds, if that's your safe asset. And so that gives you the expected return. And then you ask yourself, am I in a very risky or not a very risky environment? So you can make that adjustment. And that tells you how much equities you want to own at each point in time. And it's not that complicated. And you should have the amount of equities that kind of makes, that's consistent with that, consistent with, at 4%, I want 70% in equities. But if the expected return is only 2% higher than long-term, than your safe asset, then all else equal, you should only want to have 35% in equities. It's pretty straightforward. So, I'll stop here. There's a lot more to say about all of that, but that's this basic idea, that formula really hasn't been publicized that much. And we hope that our book has made it more of something that people talk about and say, the Merton share. It's like, we have the Black-Scholes options pricing formula. We have the Gordon growth model. We have the Merton share for how much to invest in risky versus safe assets.
Yeah. But when it comes to the Black-Scholes Merton formula, it takes a PhD in mathematics to fully understand it because of the complexity. The Merton share, instead, it's pretty simple. Okay, there are a lot of Greek symbols, but beyond the great symbols, it's very straightforward. The listeners you are talking to know the Merton share well because I dedicated a couple of episodes to it, and they all have a spreadsheet in episode 184, if they don't remember it, where they can plug the information and find the asset allocation accordingly. Obviously, the great topic we are going to be addressing in a couple of minutes is how to assess the expected return, which is the most important topic in finance. I always read the capital market assumptions from Goldman to JP Morgan to all the other guys, and they are super smart and super precise in their assumptions. Nonetheless, it's very difficult to have a clear understanding about how risky stocks are today and what can I expect in the foreseeable future. But before going to that, the other concept which is important to understand to really appreciate the Merton share is the idea coming from the St. Petersburg paradox and Bernoulli, and which is about the utility function. The very basic idea behind it is that I don't have to take as much risk as possible in order to get the maximum expected return, because this is not the way we behave in real life. Would you please expand on that?
Absolutely. And it's not so much about how we behave in real life. It's just has to do with the reality that the more of anything that we like, that we have, the less we value it, the less benefit it's giving it to us. So it could be spaghetti marinara. It's like, okay, like a little bit when we're hungry, a little bit is great, more is still good. But at some point, the marginal benefit is not that much. And really, the easiest way to think about it is with wealth and money, that, the first $1 million that we make and save is great. The second $1 million is great, but not quite as good as the first. And, so, that's what we care about is the utility or the benefit or the happiness that wealth gives us. And so what we want to maximize is that utility or happiness or welfare. We don't want to maximize the amount of money we have. We want to maximize the amount of benefit that we're getting from our money, our utility. In economists use shorthand of utility for that. And because there's a diminishing marginal benefit to more and more wealth, that makes us risk averse, because increasing our wealth by 20% is great. We like that, but it's not as good as it is bad to lose 20%, because that curve is concave. So when we lose, we're going further down in happiness than we go up in happiness when we make 20% of our money. And that makes us risk averse, and we should behave, that we will, if we think about it, we'll behave consistently with that. So it's not a behavioral economics sort of thing. It's a totally rational, sensible approach to making decisions under uncertainty. And it's classic, it goes back, 400 years or 300 years. This idea that what we should try to maximize is our utility and not the expected value of our wealth. If we try to maximize the expected value of our wealth, it leads us to decisions which are just obviously, things that we wouldn't want to do and are incorrect.
Yeah. This is a great concept, because otherwise there would be a paradoxical conclusion that one should be taking unlimited risk to get unlimited return.
Exactly. Yeah, with an almost 100% probability of losing all your money, right? Like nobody would, right? So, one way of really seeing it is imagining I can flip a coin that has a 60% chance of landing on heads, 40% on tails, and I can bet my wealth on that. And I can flip the coin 100 times, let's say, one time after the other. Well, the strategy that maximizes my expected wealth is to bet all of my wealth on heads every time. People don't see that right away. You have to kind of play with the numbers a little bit to see that. But that is the strategy that gives me the highest expected wealth. The only way that, and really it's simple, that I need to flip heads 100 times in a row, which is almost impossible. But if that happened, I would have $1 trillion, whatever. And if I multiply the probability, that tiny probability, times that huge amount of money, which is more than all the money in the world, that gives me the highest expected value. And the fact that in 99.99999% of the cases, I'm broke, that I flipped tails one time is okay, because this gives me the highest expected value. But clearly, everybody's intuition is that doesn't make sense. That I don't want to do that, and that's and that takes us to the solution of that's like not as beautiful as the St. Petersburg paradox that Bernoulli showed these ideas with, but I think it's just as intuitive and powerful to see that.
No, it's a great solution. And I encourage people to read through the experiments you did with a lot of supposedly well-educated people about assessing the right amount of money they should be betting in this kind of bet with astonishing results.
Yeah. Well, they were well educated, but not educated in everything. Like this wasn't something, that these ideas are not really taught very frequently in most programs. I think now, actually, it's been a while that these ideas have been bouncing around, and I think now, that it does get covered in many different finance courses in universities. But like 10 years ago, much less so, until you went up to, like, the first thing that you would learn if you would be doing a PhD in finance would be these ideas. But, if you're doing finance at a more introductory level, they wouldn't come in right away.
Yeah, totally. This is a podcast about, let's say, passive investing. I know the concept of passive is misleading, but you have said passive stock selection does make sense, but there is no such thing as passive asset allocation. What do you mean by that?
Exactly. That's exactly what I believe. Thank you. So what I mean by that is that investing in stocks according to a market, using a market cap weighted index fund to invest in all the stocks in the world, is a pretty sensible, good solution. It's something that makes a lot of sense to do this market cap weighted stock selection, and I would call that passive stock investing. Now, in a theoretical, in a full blown kind of analysis, you might not exactly come to that, but it's very close. It's a very good, close approximation to how we should invest in stocks. So I would say that if that can be done in a low cost way, tax efficiently, etc., then that's a good solution to how to allocate your money within the stock market. And I would call that passive stock investing. However, when we come to the question of, okay, now I want to decide how much to have in stocks and how much to have in fixed income, can I just say, well, I'm going to also do market cap weighted investing. So I'm going to invest, the amount I'm going to invest in stocks is going to be equal to the market cap of all stocks in the world divided by the market cap of all the stocks in the world and all the fixed income in the world. Well, in a way, we can see that probably doesn't make sense because we know that there's about $100 trillion of market cap of stocks, of public stocks in the world, about $100 trillion. But there's probably about $500 trillion, or let's call it $400 trillion to make the numbers easier. There's about $400 trillion of government bonds, investment grade bonds, bank deposits, CDs, all of these things, mortgage bonds that you can invest in. There's, say, $400 trillion of that in the world. So does it make sense for people to say, well, I'm going to put 20% of my wealth into stocks and 80% into bonds because that's the market cap weight of the two things? And the answer is no. Most people will see right away that doesn't make sense. Now, somebody might say, well, okay, that's my portfolio. I'm going to have 20% of my money in stocks. I'm going to invest in a portfolio that's 20% stocks, 80% bonds. But then I'm going to decide how much of that portfolio I want to own because I can use leverage. And sure, you could do that. And then you could say, okay, well, now I look at that portfolio and the risk of that portfolio, 20% stocks, 80% bonds, is very low risk, is very low return. And when I look at that, it's like, well, I want to have I want to be 3 times leveraged in that. Okay, well, if you can borrow money to leverage that at the same rate as what you're investing in bonds, you could look at it that way. And now what you really have is, for $100 of investment, now instead of having $20 of stocks, you have $60 of stocks. Instead of having $80 of bonds, you have $240 of bonds. And you've borrowed, all of this money. You've borrowed, $200 to make that happen. And so if you think about the borrowing of $200 against the $240 of bonds that you own and net them out, well, now you have $40 of bonds and $60 of stocks.
Yeah,
in
the
that
typical
case.
60-40.
And I just did the numbers, so they wound up at 60-40. But it's an active decision. Like, you're making an active decision about how much, ultimately, you're making an active decision about how much of that risky asset you want, assuming that the bonds are relatively low risk. And if we want to consider the bonds as being safe and low risk or risk-free, then the only thing is, how much of those stocks do we want based upon their expected return and their riskiness? And so, using the Merton share, which is a rule of thumb, but using that rule of thumb Merton share, that's an active decision. You can't just go off of the market cap of stocks versus bonds. You have to make this active decision. How much stocks do I want? How much stocks do I not want? And that's an active decision. So it's okay to be kind of passive in making your stock investments, that I want this much of NVIDIA, I want this much of Royal Dutch Shell, and doing all of that in a market cap weighted way. So I don't need to know the expected return and correlation between all of the 10,000 stocks in the world. I can just say, I'm going to go market cap weighted index fund. That's fine. I'm not saying it's perfect, but I'm saying it's fine. It's good. But I can't do that when I'm deciding how much equities I want to have versus fixed income. I need to have a view about expected return and risk and my personal risk aversion to decide how much I want to have of that. And that is fundamental finance theory. There's nothing new about that. There's nothing controversial about that. That is just logical. That is logical basic finance. So passive investing kind of makes sense. I would say makes sense with regard to stock selection. Investing in market cap weighted a stock portfolio makes sense, especially now that we can do it for almost no cost. But deciding on how much stocks versus bonds to have is an active decision. I can't just do market cap at that point. Now, in some sense, I could say the most fundamental theory is just saying I need to look at everything and decide what's the optimal portfolio. But we can shortcut it to being passive with stocks, and that's a pretty good approximation. And being active, making an active decision on how much stocks versus bonds. So exactly, passive investing makes sense in stock selection, but there's no such thing, I would say, as passive investing when it comes to asset allocation. Asset allocation is always and everywhere an active decision. And if somebody says, well, I just want to be 60-40, they might say that, and that might be the easiest thing for them to do. But it really it kind of doesn't make sense without somebody saying, this is my expected return for stocks, this is my expected return for the safe assets, and this is riskiness of them and my risk aversion. Like, you need to do that. Now, it might, you might say, I think that stocks always have a 4% return, and I think stocks always have the same amount of riskiness to a long horizon. And this is my risk aversion. And so based on these assumptions, I always want to be 60-40 or 70-30 or whatever, but at least be clear about what those assumptions are. Now, I think the assumption that the expected return of stocks relative to safe assets is constant and that risk to a long-term horizon is constant aren't great assumptions, especially the first one. It might be that risk to a very long horizon for stocks is kind of a constant, especially the risk that we care about, which is like really the risk of stocks going down 80%. Like, that might be an unobservable but relative constant always, possibly. I don't think so, but that's a little bit more of a reasonable argument. But expected return and the expected return on safe assets is always changing, and we see it. We certainly see the risk-free asset return changing all the time, and also the expected return on stocks is changing all the time. We see that if we look at the capital market assumptions of all the people, that's kind of something that's changing from 3 months. Every 3 months, they update it and change.
Yeah, in the last month, all the big names on Wall Street have changed their S&P 500 end-year target according to what was going on in the market. with Trump's post on Twitter and Threads and tariffs and all the mess which was going around. But when it comes to long-term expected return, it should be somehow easier to come up with a quite foreseeable range, though we are not very good at forecasting anything in finance. However, the most respected matrix to forecast future returns is the Shiller-Cape ratio. As far as it is concerned, you put out a great paper about a possible improvement that could make the Cape ratio predictive power better. Would you please tell us about the P-Cape ratio, because it could be one of the ideas to implement to work out the value of mu, the numerator in the Merton share, so the expected return in the long run for stocks.
The first thing is just why do we think that, without any adjustment, we make a little adjustment to it, which I'm going to talk about, this payout adjustment that you referenced. But why do we think that Cape is itself like good? Why do we think that Cape is good as this direct measurement of the expected return of equities? Well, again, what we want to think about is 1 divided by Cape, which we'll call the cyclically adjusted earnings yield. So, what that's really measuring is it's saying, let me look at the last 10 years of earnings of the stock market. I'm going to average them together. I'm going to inflation adjust them. And I'm going to say, okay, that's kind of my average earnings, cyclically adjusted. I'm going to divide it by the price of the stock market, and that's my earnings yield. And we and others believe that that's a pretty good, simple estimate of the long-term real return of the stock market. Now, the Shiller earnings yield is like this super simple thing, why 10 years, why inflation adjustment, So as soon as you start using it, like you're thinking, I can improve this, like everybody who uses it and looks at it is like, I can improve this. And the question is like, what improvements do you want to make so that people that you're trying to help to understand it aren't overwhelmed by too much complexity? And so we decided, after a long time of thinking about making a little change to it, we decided that, it's probably pretty important to make a change that just takes account of the fact that companies don't pay out all of their earnings as dividends. So if you're not paying out all your earnings as dividends, then you're going to see earnings grow faster than Cape would say. So when you're looking historically at the earnings that you want to average together to make an estimate of earnings going forward, we have to realize that earnings from 10 years ago need to be like grossed up for the fact that that there was a lot of investment over the last 10 years of retained earnings to get there. Or it could also be just stock buybacks, or kind of the same. A stock buyback is the same as retained earnings in that sense. And so we made this payout adjustment. Now, Shiller, that you can get the Shiller data from Bob's website from Yale. You can download that data. It's wonderful. He provides it, free, and that's wonderful. And actually, I forget how long ago, maybe 2-3 years ago, maybe 4, I don't know. He added a column in his spreadsheet for a payout adjustment. And because he also thought that, because the payout ratio has also changed over time, that it used to be that companies paid out a lot more of their earnings as dividends, and today companies pay out less of their earnings as dividends, that fraction change. So Bob made a change to his spreadsheet for a payout adjustment. And we thought, we should do it too. So we did it. We did it in a different way than he did it. I don't know that that's worth going into very much, but the way that we did it is in a way where we're adjusting those earnings so that we tried to preserve the predicted. We wanted to make earnings yield more predictive, as not as a regression input, but just as a predictor. So it's like, here's the earnings yield, here's my estimate. And we wanted to do it that way, whereas Bob did it like a simpler way, but in a way where you now need to use Cape in a regression to come up with the estimate. So we wanted to bypass like using the regression at all and just come up with something that's a direct estimate of the expected return. So Now, interestingly, we talked about the capital market assumptions of all the different banks and investment managers out there. And, they're not using CAPE. They're not using the earnings yield. They're using the earnings yield and 10 more things, plus their own, deep expertise, whatever. So all of them have a slightly different number, but when you average them together, it's not very far from 1 over CAPE. And also, if you look at the U.S. market and the non-U.S., all the rest of the world, and you look at these assumptions from the banks and all of that, they also see non-U.S. equities as having a higher long-term expected return. And indeed, the earnings yield of non-U.S. companies is much higher than the earnings yield of U.S. companies. So if you average all that stuff together, you come up not too far away from 1 over CAPE or 1 over P CAPE as we use it for the average of all of those estimates. So even though they're not using that, we just use that as the only thing that we use because we just want to maintain simplicity, transparency, all of that. But, it's not too far from the average of everybody else. So, everybody is, somehow it's like it's somewhere in everybody's calculation who's thinking about long-term expected returns of stocks. It's somewhere in their thinking that, 1 over P CAPE or 1 over CAPE, the earnings yield is a pretty good basic estimator of the long-term expected real return of a stock market, of a broad stock market.
Okay. And now let's say the P CAPE is the one metric we choose in order to allocate our money in our own portfolio. It turned out, according to your paper, that the P CAPE is more precise because the CAPE ratio tends to underestimate the 10-year returns by 19%, if I remember well.
10-year earnings, the 10-year average earnings.
10-year earnings, sorry. Yeah. So the CAPE ratio is a little bit pessimistic about the expected returns.
Is the standard CAPE, the standard CAPE earnings yield or cyclically adjusted earnings yield is a little bit of an underestimate for that, yes.
Okay. Let's say the P CAPE is the right one we pick for our asset allocation. And you suggest a dynamic asset allocation over time because obviously the expected excess return changes. But this is counterintuitive if one is accustomed to the idea of picking, for example, a lazy portfolio like the 60-40 and stick with it forever. Instead, dynamic allocation aims to maximize expected returns by investing more in stocks when they should deliver better returns. For example, now it's the opposite case because stocks in the US are very expensive and then we should be lowering our allocation to them. But the question is, how can one hedge from the risk of very bad timing? I remember that in 2014, for example, all the capital market assumptions were very pessimistic about the coming decade. But it turned out it was going to be a great 10 years period for the US stock market. So it's easy to miss great returns if you change your allocation over time according to these estimates. Let me better understand this.
Yeah. So of course, we're always talking about expected returns. We're not talking, we can't predict what the market's going to do. So we have an expected return and then, a market does a lot better than that or a lot worse than that. That's just the risk of the stock market. Now, for most investors, what they're doing is they're young, they're working, they get to middle age, they're working, they're earning, they're saving, they're investing. And, they're kind of getting this natural averaging of the stock market over time. So, in terms of, the exposure to bad timing decisions or ex post bad timing decisions, that's smoothing things out for them as well. I think that that whether you decide to be dynamic, these are two sides of the same coin. It's like, okay, I underinvested in U.S. equities. They went up a lot. Oh, that's bad. But if I had a static allocation, I would be overinvested in US equities. And what if they went down a lot? So, I think that on an ex ante basis, looking forward, that, they're kind of the same things. And if you're doing what you believe is the right thing to be doing, then you can live in peace with your decisions. So, if you kind of say, I know that dynamic asset allocation is the right thing to do, but I'm just going to be 70-30 all the time. Well, now you kind of, now you're in the situation where if stocks do poorly and you should have been underweight, that's going to bother you because you were like, gosh, I was just kind of lazy. I knew that I should have had less stocks. Why didn't I do what I knew I should do is right? And conversely, if you don't really believe in dynamic asset allocation, but somebody told you to do it, but you didn't really want to do it, and then you're underweight U.S. equities and they go up a lot, you're going to feel bad because you kind of didn't want to do dynamic asset allocation to begin with. So I think that there are really two sides of the same coin, and the important thing is to think a lot about what you want to do, and then do it, and make sure that you're confident and comfortable with what you're doing, and then the cards will be dealt and be played out, in however they are. And if you really have confidence in what you're doing, you'll be at peace with that. But I think that for many investors, kind of doing a more or less static asset allocation is if you're going to do it yourself, that's the most comfortable thing to do. But you should still keep an eye on things from time to time. There are these times when, if you were a Japanese investor in the late 80s, if you were any investor in 2000 and 2001, it made sense to be keeping an eye on things. Equities were just not offering the kind of returns that warranted having most of your money in equities at those times. And I would say the same thing for right now, that right now, you should not have most of your money in U.S. equities. Nobody thinks that they're giving, there's nobody who's looking at the future thinks that the expectation is they're going to provide a really good return that would warrant having most of your money in U.S. equities. Now, they might still keep going up for a long time, but, anybody that's looking to the future sees that how can this happen, given that they have an earnings yield of 3.5% or something like that. How are they going to do that? And, how are they going to give me a much better return than, what I could get by having my money in a safe asset, more like tips, inflation protected bonds, like U.S. equities, maybe they give me an extra 2% return over tips. Sure, I want to own some of them. Maybe I have unrealized gains. I don't want to pay taxes. I don't know if that's a good idea. I think sometimes it's good to pay taxes. But to have most of your money, to be 90% in U.S. equities with today's market environment, to me, just doesn't make a lot of sense. So I think everybody, even if you want to have mostly a static asset allocation, you should always be eyes open about what expected returns look like. And it's not that difficult. And you don't have to do it every week. You can do it once a year. You can do it every once in a while. Even if you're, a do-it-yourself investor, you should be looking at that and thinking about that, and not just taking the last 5 years of return and extrapolating that into the future. I mean, I think we're going to get into this. I think the biggest mistake that we as investors make is to extrapolate the recent past into the future, or even to extrapolate the long-term past into the future. If we can if we can make an estimate of expected returns in the future, we shouldn't even care about what historical returns have been. It's like somebody says, I can buy this 10-year bond. It's trading. It has a coupon of 5%. It's trading at 100. It has a yield of 5%. Okay. I could buy this bond. It has a yield of 5%. It has a 10-year maturity. And you say, it's like, okay, I'm going to make my decision, based on this bond has a yield of 5%. If I hold it for 10 years, I'll make 5%. And then somebody comes along and says, you know what? Over the last 150 years, if you had kept investing in 10-year government bonds, you would have made 10% on average. And the person says, oh, okay, so if I buy this bond, I'm going to make 10% over the next 10 years. Well, of course not. You're going to make 5%, right? Like nobody would do that. That's basically what's happening when somebody says, oh, over the last 150 years, US equities made 10% return. So they're going to make 10% for the next 20 years. It's the same. It's really almost the same analysis. And while we would never do it with bonds, a lot of people do that kind of thing with stocks.
Yeah, it's remarkable, to quote AQR's Antti Ilmanen, that investors in bond tend to be mean reverting, while investors in stocks tend to extrapolate, and this leads to a wide range of bias. And speaking about biases, there is a lot of biases when it comes to investing and making decisions with our own money. The recency bias is one among them. For those who started investing after 2009 and don't know history, it's easy to fall into the trap of US exceptionalism. For example, in the last 15 years, the US delivered an astonishing return against any other asset class. But this is a poor guide for future decisions. And this is one of the typical biases that lead people to make bad decisions with their portfolios. This year, we have seen people freaking out because of what happened in the markets, because of all the tariff turmoil, etc. The Standard & Poor's 500 near the bear market territory in April, and people was freaking out despite that they should know that investing in stocks is for the long run and they shouldn't be worried about intra-year corrections. What psychological bias, in your opinion, has the biggest impact and makes people make decisions that are suboptimal for their future goals, future welfare, and future happiness?
So I was recently reading an article by a Yale professor who I really like, a youngish Yale professor. His name is Nick Barbaras, and he kind of did this whole survey of tried to do it like a meta study survey of what does behavioral finance say about asset pricing? And so I just want to give him credit for shaping my answer to your question, that he really illuminated things for me where I see the answer to your question is there's two main things that we people do from a sort of psychologically evolutionary program point of view that are very, very harmful to our long-term financial success. And those two biases, those two behavioral foibles or things that we do can be summarized into these two things. The first one is extrapolation, is an extrapolation bias. And the second one is overconfidence. So, and when he writes this paper, there's so many behavioral biases that we have, right? I mean, that if you go on ChatGPT and say, give me a list of financial behavioral biases that economists have found, you will find, I think that you might find 100 different things. 100 different things that we have there. The fallacy of small numbers and anchoring bias and this and that and all these different ones. But really, for me, I think that if we just think that these two main ones, capture so much of what we do that that can hurt us, the extrapolation bias and overconfidence, and these two biases explain so much of the weird things that we see in asset prices, bubbles and busts, and all this trading activity. The puzzle of why is there so much trading activity in the market, makes no sense from a kind of theoretical point of view. Like, why are we all trading with each other all the time? $1.5 trillion of short-term stock options and individual stock volume and all this stuff. These two biases illuminate so much, overconfidence and extrapolation. And, I think that if we recognize those two things and we say, okay, what am I doing, that's like coming from my tendency to want to extrapolate from the past? And what am I doing that's coming from this overconfidence that we all have, or that many of us have? that can really, I think, help so much to get to better places with our financial decisions. So, I think, I think those, to me, he had a third one in his article. If anybody reads his article, he had a third one, but I don't think the third one is nearly as valuable as the other two. So I'll just leave that one out.
Yeah, we could make a separate episode about it. It would be a very interesting one. I suppose that most of the ideas we discussed today, which are at the very core of your investment philosophy and the way you manage your company, come from your background and your experience. And I also suppose that the LTCM experience was a milestone in your career for the good and for the bad. We all know the story. LTCM is one of the greatest stories in recent finance because of the incredible people that funded it. It was called the Nobel Prizes Hedge Fund, thanks to Myron Scholes and Robert Merton being the funding partners with you and John Merriweather. You guys had groundbreaking ideas at that time and deliver astonishing results. If you don't mind, I'd love to have you tell us about the principles upon which LTCM was funded and what happened, because it went through a great run for 4 years and then the market went crazy in a few months. I can't help but imagine that there is a link between that experience and the ideas we have discussed today.
Sure. Yeah, absolutely. I think that, I think that it's always been felt that markets are only partially efficient, that they're not fully and perfectly efficient. And sort of there's this kind of, paradox, right? That if the markets were perfectly efficient, then nobody would be incentivized to help to make the market perfectly efficient.
Yeah, the Grossman-Stiglitz paradigm.
Exactly, the Grossman-Stiglitz, which I think goes back, was almost worth talking about a little bit more before we even came to the LTCM topic. But I think that practitioners and theoreticians have always believed that there are limited inefficiencies in the market that provide enough expected return and profit for people to devote capital and labor to helping to make the markets more efficient, to make prices more right. And this activity. That one place where this activity was happening a lot, in the 1970s and after, was in different investment banks, in particular in investment banks more than commercial banks. And it even was happening. It's happening for a long time in trading houses and banking organizations going back for centuries. Wasn't a new thing. There was this activity going on of trying to benefit from segmented markets, from the price of one set of cash flows being different than the price for the same set of cash flows packaged in a different way. And in general, when you're looking at two things that are nearly the same but have different prices, the return that you would get from buying one and shorting the other one, that the return is not enough to motivate capital to want to be dedicated to that. Because if the two things are really similar to each other, their prices might be different, but not that different. And so, it winds up being something where leverage is typically used to generate a high enough return on capital that people that have the capital want to dedicate it to that, rather than just investing in the stock market, where you can also get an extra return by taking risk. And so this is what LTCM was based upon. It was based upon a trading and investing approach that had taken place at Salomon Brothers, the investment bank in New York, from the early 70s until for 20 years, for like 2 decades. and overall, it was a very profitable and attractive risk-return, attractive investment strategy over those 2 decades or so. Where it was going on there. At some point, due to a confluence of different factors, the head of the proprietary trading operation, John Merriweather, decided to carry on this activity on a global basis outside of Salomon Brothers, raising outside capital to do that. And that was the birth of LTCM. We were about 10 partners.
It was a record raise for the time.
Yeah, the as a startup hedge fund, as a new hedge fund, that was a time when $1 billion was a lot of money, and LTCM raised $1 billion. These days, hedge funds have there are hedge funds out there with $70 billion, but back then, if you had $1 billion, that made you one of the biggest hedge funds in the early 1990s. Not the biggest, but one of the larger ones, and certainly that was one of the largest amounts of capital that had been raised for a new hedge fund at that time. At that time I was 31 years old. I was the youngest partner of the founding partners, and we started our business with outside capital, trying to do what we were doing, within Salomon Brothers with a global operation. I was based in London. Spent a lot of time in Italian markets doing trades with different Italian instruments, in particular, and different Italian government bonds, and so on. And anyway, so that's what we were doing from 1993 onwards. We found over time that doing this as a standalone pool of capital outside of an investment bank, was probably not a very good business model for what we were doing. And ultimately, when 1998 came around, we lost 90% of our investors' capital, which was mostly, by that time, it was mostly our capital. Our hedge fund was just over $4 billion, or closer to $5 billion, I think, at the beginning of 1998. And during 1998, we lost about 90% of that capital. Luckily for many of our investors, we had paid out a very large dividend in 1997. So most of our investors were fortunate that they made close to a 20% IRR on their investments from 1995 until 1997. But yeah, it was quite a terrible experience for all of us involved there, for all of our internal and outside investors, and I think that all of us that were involved learned a lot of lessons from that, changed things that we did. In my case, that was kind of the end of or it was the beginning of the end anyway of wanting to do leveraged and concentrated investing, and really move me towards eventually what we do at Elm Wealth, which is no leverage, broad diversification, using market cap weighted index funds to have equity exposure, and doing dynamic index investing. Pretty big difference. We charged high fees at LTCM. What I've been doing for the last 13 years is something, charging, I don't know, 1/40th or 1/50th of the fees. But the right fees for what we're doing. We're not doing what, I'm not saying those were the wrong fees for what we were doing, of doing something different that happens to have fees that are much, much lower. So I think that in our book, in the Missing Billionaires book, we have a chapter devoted to LTCM. My partner and co-author James had his own experiences at Citadel that were a little bit less publicized, and didn't have quite the same ending point that we had at LTCM. But in 2008, Citadel was had very, very large losses during 2008, which they survived and have thrived, and I'm sure have learned many, many great lessons from, and have grown since then. LTCM, unfortunately, we didn't. I think if we had survived that, we probably would have wound up doing things very differently, into the future. So yeah, there's a chapter about LTCM in our book, which is now, I don't know, it's now out in paperback. I don't know if it is in paperback in Europe at this point. There's hardcover, but yeah, chapter 8 is all about the LTCM experience and lessons learned. Some longer discussion about lessons learned and things that hadn't been discussed that much in financial press. Yeah,
it is a great chapter because I tried to imagine what could mean to be in that situation with so much skin in the game and doing great numbers for a very long time, and then suddenly being wiped out from the market without being wrong, because the trade was right, the idea was right, it all came down to an incredible chain of events, highly unlikely to happen. It took the default in Russia, what happened in the emerging bond markets, other banks not providing the liquidity, Warren Buffett in Alaska with Bill Gates, so a lot of unbelievable situations all at once. Do you think that if you knew back then the Merton share framework, you would have made different decisions, for example, with your own money invested in LTCM?
Yeah, so I think that the thing that's clearest to me is that if I had been thinking about things with the ideas, not the knowledge that something bad was going to happen, but just the ideas of maximizing expected utility, that I think are so important for all of us to think about today. If I had been more focused on that framework back then, the biggest thing that would have been different is that I would have had much less money in LTCM. That's the first thing. I have no doubt really that from a personal point of view that would have been the case. I think the other thing that would have been much clearer to me is that the value, the expected value of the business, I think, was higher to us by going down a path towards privatization, in effect, by giving this big dividend to investors in 1997. I think it's arguable that decision was a decision which increased the expected value, the expected wealth of all of the partners. But I think that it is more questionable whether it increased the risk-adjusted value of our wealth and of our business. So another decision that we could have made, which a number of the partners were in favor of, but ultimately we didn't make that decision, even though some of the partners were in favor of it, was to go in the other direction and to raise a lot more capital. People wanted to invest with us so much. We could have, instead of paying a dividend to investors, we could have kept all of that capital and then raised another $5 or $10 billion and then changed our fee structure somewhat so that investors would be getting, a LIBOR plus 5% return instead of these 40% returns that we were getting in the years from 93 to 98. So I think the expected value maybe would have been lower, maybe not, but maybe would have been lower. But the risk-adjusted value, the expected, which is the important thing, expected value is not what we should have been maximizing. We should have been maximizing the risk-adjusted value of what we did. And I think that, if we had been more focused on that framework, we would have said, okay, you know what? The expected value of doing this for us is going to be lower, but the risk-adjusted value is much higher. Let's do this. Let's become a $20 billion fund instead of becoming a $4 billion or $5 billion fund with most of our own money there. So I think that, I don't think I wouldn't change the trades we did, even though those trades lost a lot of money. And I don't think there was any way, we always knew that those trades could lose money before making money. So, I don't think that is where we would have made changes based on what we know, based on how we think about things today. And of course, all of these ideas, have been known about for a long time. It was more a question of focusing on them. So it's not like, these ideas were only discovered. It's not fair because they were only discovered now, but so you couldn't have known them back then. The sad thing is that these ideas were all known back then, and we could have been more focused on them, or I could have been. Yeah.
Victor, thank you so much for the time we spent together today and for the bunch of time you dedicated to us. I really appreciate it. And I hope you will come back in the future because I still have 20 to 35 questions I'd love to ask you.
Yeah. Well, I love Italy, and I spent so much time in Italy, not just for business, but no, it's absolutely terrific to be connected and to be connected with an Italian audience. I hope people will come to our website, and we have some products that might even make sense for Italian investors. I don't know the whole tax, the fiscal side of things is so complicated. I don't know, but anyway. We hope that we'll have a chance to connect more with and help more with Italian investors, and maybe our book could even be translated into Italian someday. It's been translated into Chinese and Korean, into Mandarin and Korean, but I think otherwise it's staying in English. So
I hope it too, and if I can, I would be a great sponsor for it. People, you can read it in English. It's easy to understand. There's a lot of graphs and very cool drawings. And you can see a comic-style illustration of Victor drawn in the book. And Victor, thank you so much. Really, it was great to have you here.
Thank you very much, Ricardo. Thank you.
Thank you. Bye-bye. And that's all, folks. I hope you enjoyed the episode and that it gave you some new tools to address the most fundamental question every investor must face. A huge thanks to Victor for joining us and for the incredible insights he shared today. You will find the link to The Missing Billionaires in the description, which is his phenomenal latest book, along with the website of his firm, Elm Wealth, where you will find fantastic articles, resources, and his asset allocation tool. Very interesting, check it out. If you haven't already, don't forget to hit follow and turn on notifications on Spotify, Apple Podcasts, or wherever you are listening. And please leave us a 5-star review to support the show and help us keep bringing you fresh content that tries to answer finance's ultimate question. That's really all for today. I'll see you next Wednesday with a brand new episode right here, of course, on The Bull, your personal finance podcast.